Welcome to the Mortgage Minute on calgarymortgage.com. Thanks for taking the time to tune in today and watch this video. Today we're going to talk about the 6 things that we've identified as being important when you're getting a mortgage. Now, most people think that the most important thing to look for when you're getting a mortgage is the interest rate. But as you'll notice on our little chart of the 6 things that are important, rate comes last, and there's a reason for that. Interest rate is often the indicator of the price, but not the actual price when it comes to mortgages. And to elaborate on that and to give you an example of what I mean by that, let's talk about cars for a second. When you walk onto that BMW dealership lot and you see two brand new BMWs, black BMWs, that look pretty much identical, same model, same color, but one has a higher price, what do you typically think about the difference between the lower price and the higher price model? Well, most of us will understand that the higher price model probably has several more features than what the lower price model has. Maybe it has navigation, maybe it has leather seats, but there's a difference between those two cars even though they look identical. Well, the same is true for a mortgage. You can have two mortgages at exactly the same rate and they could be completely different as far as features go. And more importantly, when you start getting into those super low interest rate mortgages that you'll see advertised on occasion, they can come with things that haunt you more than you'd ever imagine. And we see our job as simple. Our job is to help people avoid the inevitable, help people avoid the future implications of bad decisions in mortgages. So let's talk about the 6 things that we think are important to consider when you're getting a mortgage. And by the way, these 6 things, they're simple to understand, they're simple to see, but the only way to truly understand whether your mortgage has them or not is to have expert advice from somebody who understands the differences between mortgages. We see all the time mortgage brokers, mortgage specialists, bankers completely confuse the fact that completely confuse whether or not their mortgage has these terms. For example, my mom was a BMO banker for 47 years, and about 7 or 8 years ago they introduced what was called a bona fide sale clause. It basically meant that you couldn't get out of the mortgage unless you sell your home. Well, I was the first one to tell my mom about this because I found one in my personal mortgage. She didn't even know, even though she had been there for 47 years. So quite often, you find mortgage specialists and mortgage brokers that just don't understand what they're selling. So second opinions, independent advice from somebody who understands the differences between mortgages is highly important. So let's talk about the 6 things that we think are very important when getting a mortgage. And when a client comes in to see us, we go through these 6 things, but we make it very simple by having a conversation and asking questions that basically help us narrow down the lender that meets the client's requirements. So for example, you look at things like portability. Portability, in our opinion, is the most important thing, or at least, no, you know what? It's the most important thing when it comes to getting a mortgage. The reason why is, if you ever decide to move, you've got to know whether or not A, your mortgage is portable, and if it's portable to be moved to where you're going. So for example, there's lenders out there that only lend in one area. Maybe it's Calgary, maybe it's Alberta. But if you decide that you want to move to BC, or maybe you get transferred and you have to go to BC or Ontario or another province, if you've picked the wrong lender at the beginning, you may not be able to move your mortgage to another province. So, or another area like a city. So in order to make sure that you have the right portability in your mortgage, we always ask the question, do you ever plan on leaving Alberta? And if there's that hesitation, that moment of maybe I might consider it, we always talk about the implications of choosing certain lenders. Now, the other thing you need to know is that some lenders just have mortgages that aren't portable at all. And those mortgages, they can be costly. And the reason they can be so costly is because if you have a mortgage that's not portable and you do decide to move, you can be forced to pay a payout penalty. Now, if you're forced to pay a payout penalty, you could end up giving a whole bunch of your equity back to the bank. So let's talk about penalties for a second. We've talked about payout penalties and how they're calculated in the past. We've talked about interest rate differentials in our videos. Payout penalties, in my opinion, aside from portability, are the most important part of a mortgage. We know that banks charge higher payout penalties than a lot of their monoline lender counterparts. Again, monoline lenders are lenders that do only one thing, and that's sell a mortgage. We also know that there are certain lenders out there that aren't banks that have excessively high penalties because they sell the mortgages off to investors who want higher penalties. So understanding how the payout penalty is calculated and understanding what goes into those penalties is highly important. In fact, if there's one thing that is more important than interest rate in getting a mortgage, it's how the payout penalties will be calculated. Because you may have a 2.59% interest rate at one lender and a 2.59% interest rate at another lender. And when you go to pay out the mortgage, one could cost you significantly more money, even though the interest rates were the same. So this is important, payout penalty. We also talk about consistently what type of mortgage you're getting into. There's two main types of mortgage charges. The first is a normal mortgage charge, and the second is a collateral mortgage charge. I'm not going to go into the details of them in this video. Maybe we'll save that for another day. But one can cost you more to get out of than the other. So something to consider is how the lender charges your mortgage. Number 4 is prepayment privileges. Now this is a big one, because if you want to pay that mortgage down faster, if you want to make any sort of gains in the amount of time it takes, these prepayment privileges are going to be what allows you to get out of that mortgage quicker than the 25 years that you originally signed up for. And these can often be confusing. For example, some lenders will say that they have a 20% prepayment privilege, but really they have 10% and 10%. So 10% you can increase your payments and 10% you can make lump sum payments. And they call that 20%, but it's actually not. So prepayment privileges are something that you really want to consider and understand that there's basically 3 types of prepayment privileges out there. There's 10 and 10, 15 plus 15, 20 and 20. Obviously, the higher your prepayment privileges, the better. The higher your prepayment privileges, the faster you can pay the mortgage off. And in some cases, the higher the prepayment privileges, the less the payout penalty will be. So this is highly important, especially if you're looking to make those lump sum payments. And just because you don't think you're going to use them in the next 5 years doesn't mean that you don't want to look to these to the future, because 10, 15 years down the road, when you're ready to make that one lump sum payment to pay the mortgage off in its entirety, you may realize that you want that 20% instead of the 10%. And because you made a bad decision 15, 20 years ago, you're only able to pay off a small portion without penalty rather than the whole thing or a larger portion. 5th thing that we look out for is lender stability. Now, most brokers in the industry will understand the stability of different lenders. About 5 years ago, there was 20 to 30 non-Canadian lenders in the Canadian mortgage market. Now there's 1 or 2. So when you're considering lenders, a foreign lender may not be the best choice because it may be something that doesn't necessarily exist 3 or 4 years down the road. In addition to that, small lenders, not the big monolines, but the small lenders, it may be questionable whether or not they're going to exist 3 to 5 years down the road. And if lenders go out of business, what typically happens is you end up with what's called an orphan mortgage. And having an orphan mortgage will simply mean that they're not willing to renew it, and you have to go out and find a different lender. And if circumstances change, that could cause a problem. So once we go through the first 5 things here, portability, penalty, type of mortgage, prepayment, lender stability, and we ask the clients how they feel about each one of these, they'll typically give us enough information to narrow down the lenders to 3 or 4 that suit their needs. Once we know the 3 or 4 that suit their needs, then we start looking at interest rate. And typically at that point, we'll look at 2 things. We'll look at, do they want a full service bank, one where they can go in and yell at somebody if they have a problem? Or are they comfortable with a lender that does telephone banking only, for example? Then, based on that information, we'll compare the different products between the lenders that meet their needs. And as a last step, we'll pick the one that has the lowest rate. Now, the interesting thing is when we go through this whole process, something interesting happens. Clients who otherwise would have just picked the lowest rate when looking at a rate sheet start to pick an interest rate that's slightly higher than the lowest interest rate, because they're not picking the mortgage based on rate anymore. They're picking the mortgage based on product. And when they pick based on product, they end up often picking a higher interest rate mortgage that meets their needs. And because it meets their needs, what it usually means is over the long run, it'll cost them a lot less money. So these are the 6 things that we think are important when selecting a mortgage. Starts with portability and payout penalties, ends with interest rate, and if you understand all of these things, you'll be able to make the right selection for you.